Here's what's coming up on Retiring Well with Michael Reese.
Normally, there are so many more choices available outside of a 401k in your own IRA, where you can elect some of those choices and you can do a better job preparing yourself for a comfortable retirement that's coming up. Let's go ahead and look at a typical variable annuity and all the fees that you're being charged. And guess what? You don't see any of them on a statement. None of these fees are seen on a statement. The only time you see them is if you open up and read the prospectus.
You know, Mike, I really have to say, when it comes to retirement planning, that point where you fundamentally have to change your philosophy in investing, we're rarely using mutual funds at all.
And now the host of Retiring Well, Michael Reese.
Hi, welcome to this week's show. We have 30 minutes of action-packed information designed specifically for you. Grab your coffee and a pen and paper because Retiring Well starts right here, right now.
Hi, and welcome to this week's AskMikeCFP.com, where you email your questions into us and we answer them here on the show. Mike, my first question is for you, and it is from Bill, and he writes, Mike, I'm 59 and a half in December, and my 401k plan lets me do a rollover at that time if I want. I think I'll work at least until I'm 66. What is your opinion about doing a rollover while you are still working?
Well, that's a great question, Mark. And for Bill at home, I mean, there's a lot of reasons to roll over from a 401k to your own self-directed IRA. One of them, of course, being that you normally have more investment options. But just because there are reasons for, more investment options, more control, that doesn't mean that necessarily it makes the most sense. Because what if his 401k, Mark, has really like a large number of options that are very competitively priced? Maybe he has some very inexpensive options in there that would work really well for what he's trying to accomplish. There's nothing, if that's the case, maybe leaving money there makes sense. But on the other hand, that's not normally the case. Normally, there are so many more choices available outside of a 401k in your own IRA, where you can elect some of those choices and you can do a better job preparing yourself for a comfortable retirement that's coming up. I mean, gosh, he's looking at what, 6 years away, I think you said? I mean, with that kind of time frame, he's coming within that retirement red zone. He needs to start setting himself up for future income and future security.
Bill, thanks for that question. John, my next question is for you, and it's from Cheryl, and she writes, I have an annuity that I inherited from my mom who passed away earlier this year. What am I supposed to do with this account? The insurance agent she bought it from is no longer in the business, and I don't even know what I'm supposed to ask the annuity company when I call them?
Great question, and sorry to hear about that. So with that annuity, you have different types of annuities, obviously, and there's going to be different tax ramifications for the decisions that you may make. So there's going to be opportunities there where you're going to be looking at whether to take it out as a lump sum, and with that, there may be significant tax consequences if that's going to be either an IRA or sometimes it's non-qualified money. And the definition of that means that it's money that was put in after tax, and then there's been earnings on that annuity over the years or interest earned that hasn't been taxed yet. So that may come out as a lump sum and you pay taxes on it all at once. They give you options within the insurance company where you could take that payout over a period of years, whether that's 5 years, 10 years, or sometimes over your lifetime. So there's different options there to fit what's best for your needs.
Yeah, Mark, I was thinking about that when you asked that question, and I thought, this is one of the reasons. I mean, this is why you've got to come visit with us. You absolutely have to come talk to us so we can help understand your circumstances more clearly. So we know, look, this is exactly where you're at. This is exactly what you're trying to accomplish. Now, let's identify, given that information, what is the best way to extract the funds out? Is it, as John said, is it all at once? Is it over time? And here's the other thing with annuities. Annuities can be complex when it comes to inheriting. There may be taxes, there might not be taxes. There's a lot of ways you can take the money. And you take your circumstances that are unique, combine that with all the different options, and you can find that if you just try to muddle your way through, you may end up with taking an election of taking the money that it didn't really work out too well for you. On the other hand, because there are so many options, if you get a little guidance and a little bit of help, you find, oh, look, here's a way I can take this that so nicely fits my circumstances that ends up being a fantastic account that her mom left behind.
And something too is it may not actually be the insurance company's job to determine how to go about that. That's where you want some type of personal relationship, or like Mike said, the second opinion from a financial advisor to fully understand your situation and what you want to do.
Mike, John, thanks so much. Cheryl, thanks for your question. Hey, if you'd like to have your questions answered here on the show, it's really easy. Just go to AskMikeCFP.com. We look forward to answering your questions right here. Don't go away. You're watching Retiring Well with Michael Reese, because your best is yet to come.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For a complimentary consultation, simply contact us today.
Hi, I'm Michael Reese, and I would like to invite you and a guest to enjoy a complimentary evening of food, fun, and information with me at our next financial education dinner event. We are going to discuss the important issues that can impact your portfolio and your retirement. These topics include: can you protect and preserve your assets against market volatility? Can you prevent outliving your money? How do decisions in Washington, D.C. affect your retirement? How to make sure that your current advisor is giving you the right advice? Can you find growth and security without risk in today's volatile market? Why getting a second opinion may be the most important financial decision of your life, and so much more. If you are a retiree or pre-retiree in the Central Texas area, then now is the time to take control of your retirement. Call us now as seats are limited. I look forward to seeing you soon at our next dinner event.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Welcome to this week's edition of Coffee Talk. I am here with Art Canfield, one of the advisors at the office. Art, thanks so much for being here today.
Yeah, thanks for having me, Mike.
So today we're going to talk about mutual funds. I mean, if you think about it traditionally, we have all of us have built our portfolios using, for the most part, mutual funds. You know, we would go to our 401ks and we would have a menu of mutual funds, and that's what we would use to build our retirement portfolio. Yet, like in a lot of areas of life, technology changes. I mean, we're not using the old Commodore 64 anymore. and so as technology changes, there have been changes in the investment environment as well. So Art, when it comes to retirement planning, to what degree are you using mutual funds at this stage of where we stand in our environment?
You know, Mike, I really have to say, when it comes to retirement planning, that point where you fundamentally have to change your philosophy in investing, we're rarely using mutual funds at all. I mean, maybe a little bit here and there, but you know, people always are so driven to that mutual fund environment because that's all they've known they're right? They've had that menu of option in that 401k, and either their target dated funds or the certain type of mutual fund that they've been accustomed to for those years. But there's so many different things out there now that are available to us as advisors that can really help better meet the needs of today's retirees.
Yeah, it's like you're used to going to your, Fidelity is in Vanguard. They're the 900-pound gorillas in the 401k space, and or the 403b. Maybe it's VALIC or somebody like that. And you're so used to having this menu of mutual funds. I mean, it's just what you're used to. Yet, I like what you said, Art. You said, remember, retirement is and this is important, a fundamental shift, right? It's not like, ooh, I went from one job to another job. No, I've stopped working. There's no more money going in. This is a fundamental shift. So if you're not using mutual funds, then what are we using? ETFs or something else? What are you using that work better for a retiree, and why?
Absolutely. And then let me give you an example here. We had a couple come into our office just last week, I think it was, and they had a portfolio of mutual funds. They had about $1 million, and we ran an analysis. We have the ability to get behind the scenes, and figure out what's in there. What are all the positions behind that? Do you know they had 60,000 different positions of the 20 or 30 mutual funds they had?
So they had like 20 to 30 funds, $1 million, 60. Think about this, 60,000 positions. So like if I do some quick math in my head, what is that? Just like a few $100 per position or something?
That's exactly what it worked out to be. And do you think they knew what those were, or even maybe they couldn't name what 10 of them were?
Could you, now think about this. This is hilarious. This just came to my mind. Imagine that like I was your financial advisor and I came to you, I sent you a statement, and it was like this because it listed all 60,000 positions. I mean, come on. I mean, how good of a job can I do overlooking that?
Right. As a retiree, would you buy into that? Somebody that was selling you 60,000 positions.
Oh, heck no.
And so the idea, right, you want to believe that at 60,000 positions, you should be well diversified. Well, we have this thing called the stock intersection report, right? Mm-hmm. So when we run that analysis, there are so many different mutual funds holding the same thing, right?
Oh, so a lot of these mutual funds they're just duplicating their efforts.
Right. And do you think, Mike, when they go to sell something, Vanguard calls Fidelity and said, hey, I'm thinking of selling Apple today. What do you guys think? I don't want to move the market on you, right?
What you might have is like Vanguard's selling something one day, Fidelity's buying it the next day, and you end up in the same position, but you get to pay transaction costs going in and going out and coming back in. I mean, it's crazy. So what are you using? Exchange-traded funds, separately managed accounts instead of mutual funds?
There's no one silver bullet in today's world, right? I mean, we live in an environment, retirees live in an environment that's vastly different than the people that retired in the 80s and 90s are. So we're using exchange-traded funds. We may hold individual stocks directly. Maybe some alternatives need to be mixed in there for income-producing assets. I don't know until we talk to the person.
That's right. Different portfolios for different circumstances. Right. And folks, we can't say that one enough. Depending on your circumstances, that determines what your portfolio should look like. Depends on how much income you need, the risk you want to take, etc. Right? Mm-hmm. Well, great, Art, super information. If you have questions about this or anything else we talk about on the show, please pick up the phone, give us a call, or visit our website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Life, a series of moments. A touch, a look, a laugh. Successful people. It might not be superior imagination. It just might be superior retirement planning. Imagine what's next. Plan today, own tomorrow.
Having no clear retirement plan is a mistake I see a lot in our financial planning office when we meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. If you don't have a clear retirement plan, then be one of the first 5 callers, and you will receive a free Centennial 5-star analysis. There's no obligation and no cost if you have at least $250,000 saved for your retirement. Here's what you'll receive: a free report that tells you exactly what you're paying your current money managers, both what you see and what you don't see. A tailored plan to safeguard your investments from market volatility. Tax analysis to reduce liability and increase cash flow. And a custom income plan to boost your retirement. So call now for your free, no obligation Centennial 5-star analysis. And remember, you only retire once. Let's make sure you do it right the first time.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
This week, we are talking about annuities and asking the question, are they good or are they bad? Art, someone says to you, annuities, always good, always bad. What's the first thing you think about?
Depends.
Yeah,
Right?
That sounds like a lawyer answer.
Right, it's like a cop-out answer, right? You know, it's interesting. Somebody always has a predetermined opinion about any investments out there. They had a friend or family member that had a either really good experience or really bad experience with a product. You know, you say it well, Mike. There's no one silver bullet with any investments, and annuities would fall under that, right? You know, you have the options. There's so many different ones out there, and I go back, depends.
Yeah, I mean, that's one of the areas that I think people are confused about more than anything else. I think annuities as a tool, you know, that word annuity, it's used in so many different places, and it can mean so many different things. I mean, you have variable annuities and fixed annuities, immediate annuities, deferred annuities, they're all over the place. How do you lump them into one category? I'm not sure you really can.
Right. It's just like tools in a tool shed. If I was to give you a saw and told you to drive a nail into a board, what would be your success rate? Investments are no different. They're just tools available to fiduciary advisors to meet your needs.
So saying an annuity is good or bad, either one, what you're saying is equivalent of saying, well, a stock is always good or always bad, or a mutual fund is always good or always bad, or an exchange traded fund is always good or always bad, or real estate is always, you just can't lump them in these categories. You know, I think one of the things that we talk about a lot is how does it apply to your situation, right? How does it apply to your situation? So if you're looking for growth, maybe stocks, mutual funds, that might make some sense. If you're looking for income, maybe bonds or annuities make sense, correct?
Right. Mike, like this, you know, what do you think a week we see somebody comes in, the first thing they do with us is they slide across the table their statement. They say, what do you think? Is this good for me? Boy, it goes back to the depends. What are you trying to accomplish with your investments? What are your goals in your retirement? Every single person has something different. There isn't a cookie cutter investment or strategy that works for everybody.
Yeah, that makes terrific sense. And folks, as you're thinking about this, if you have questions about this topic or really anything else we talk about on the show, please feel free, pick up the phone, give us a call, come visit. Or, of course, you can always go to the website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Hi, I'm Michael Reese, and I would like to invite you and a guest to enjoy a complimentary evening of food, fun, and information with me at our next financial education dinner event. We are going to discuss the important issues that can impact your portfolio and your retirement. These topics include, can you protect and preserve your assets against market volatility? Can you prevent outliving your money? How do decisions in Washington, D.C. affect your retirement? How to make sure that your current advisor is giving you the right advice. Can you find growth and security without risk in today's volatile market? Why getting a second opinion may be the most important financial decision of your life, and so much more. If you are a retiree or pre-retiree in the Central Texas area, then now is the time to take control of your retirement. Call us now as seats are limited. I look forward to seeing you soon at our next dinner event.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
In CFP Talk this week, we are going to dive into all the fees that are associated with variable annuities. Now, before I do this, as you know, if you watch a show, you know that this is one of my big pet peeves. I mean, it drives me crazy how, the financial planning industry seems to be the only industry that works hard to hide what they're charging you. I mean, I love what we do. I think what we do is fantastic, but gosh darn it, why can't we be upfront with you when it comes to the fees? Why can't we be transparent? And variable annuities are one of the biggest, biggest challenges, I guess we could call it, in this environment. So let's go ahead and look at a typical variable annuity and all the fees that you're being charged. And guess what? You don't see any of them on a statement. None of these fees are seen on a statement. The only time you see them is if you open up and read the prospectus. So let's go ahead and dive in. With a variable annuity, the first thing that you will see in a prospectus is something called mortality and expense fees. Now, what is that? That is essentially how the insurance company is paid. So they're collecting fees, that's where they get paid, it's where they get the money to pay the advisor. Very typically, this is going to cost maybe somewhere about 1.35%. That's a pretty common number there. You might find that are 1.25%, some are 1.65%, so it does vary, but that's not too uncommon. They're collecting that every single year. Now, they'll tell you that there's a benefit for that fee. The benefit is right here, mortality. What they'll tell you is, they'll say, if you invest, as we have down here, $500,000, if the account goes down because of market performance and you die, your beneficiaries will get at least the $500,000 you put in. If it goes up in value, well, they'll get the higher number, of course, but if you die at the wrong time and your account is worth less than what you invested, you're going to at least get that. So they tell you that's a benefit of that fee. But the reality is that almost never happens. In the real world, that's where the insurance company makes money. It's where they get the money to pay the advisor. Next, we have mutual fund fees. In a variable annuity, you are holding a portfolio of mutual funds. Pretty standard for those to add up to about 1% a year. That's a pretty standard number. Now, again, maybe a little less, maybe a little more, depending on what you have. I'm just trying to give you a feel for what we're dealing with here. And then the next one, and this is an area where pretty much every variable annuity has something like this below, because here's the thing. Let's stop right here for just a minute. If you take these two numbers and you add them together, that's 2.35%. That's a lot of fees for just basically holding a mutual fund portfolio somewhere. I mean, who in the world would think it's a great idea to hold a mutual fund portfolio and pay 2.35% a year with no additional benefits? I mean, nobody would do that. But what's happening in today's world is you have income, and DB stands for death benefit riders. So there are riders. An income rider would be where a company says, look, you put in a certain amount of money, we will let you withdraw a percentage, say 5%. And you can pull that 5% every year for as long as you live. Even if you drive that number to zero, we'll still let you pull that 5% out every single year. That's an example of an income rider. A death benefit rider might be, we're willing to grow this number at a certain percentage each year and pay that out as a minimum death benefit. And typically those riders, it's not uncommon for them to be maybe 0.75% or something close to that, sometimes a little more, sometimes a little less. Now, if you add all of this up, if I do my math correctly, that's about 3.1%, not 1 year, but every single year. If you have $500,000 in an account like that at 3.1%, we are talking $15,000 a year in fees. And gosh, if you have an account like that for 10 years, That's $150,000 plus of fees on your portfolio over a 10-year period. How are you supposed to make money when you're paying those kinds of fees? Now, by the way, if you're paying $15,000 and they're earning $50,000, that's fine. But let's be honest, that's not what's happening, is it? You're paying $15,000 and they're lucky to break even in this day and age. So it's important that you understand all the fees you're paying. In our belief system, these should all be transparent and laid out for you, not just when you invest, but every single year. Now, if you have questions about this or anything else we talk about, please either pick up the phone, give us a call, come visit, or visit our website.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Remember when life was simpler? When things didn't move quite so fast, and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, and still a bit uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today.
Having no clear retirement plan is a mistake I see a lot in our financial planning office when we meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. If you don't have a clear retirement plan, then be one of the first 5 callers, and you will receive a free Centennial 5-star analysis. There is no obligation and no cost if you have at least $250,000 saved for your retirement. Here's what you'll receive: a free report that tells you exactly what you're paying your current money managers, both what you see and what you don't see. A tailored plan to safeguard your investments from market volatility. Tax analysis to reduce liability and increase cash flow. And a custom income plan to boost your retirement. So call now for your free, no-obligation Centennial 5-star analysis. And remember, you only retire once. Let's make sure you do it right the first time.
You're watching Retiring Well with Michael Reese, because your best is yet to come.
Thanks for watching this week's show. If you have questions about anything we talked about today or any other area of your retirement planning, please feel free. Give us a call or visit our website. Remember, you only retire once. Let's make sure you do it right the first time. We'll see you next week.